Welcome to the Tax Talk Podcast. Are you interested in investing but don't have a clue as to what account to invest in or what type of investment is right for you? Well, you're in luck. On today's episode, I will be chatting with Stefan Van Zanten of Bridgeline Wealth, and we will provide you with some clarity on this common problem that faces Canadians right across the country. Stefan, thank you very much for taking some time to join me on the podcast today.
Oh, you're welcome. Glad to be here.
Excellent. So today's problem, you've heard the acronyms before: RRSPs, TFSAs, RESPs. You've probably also heard about stocks, bonds, mutual funds, EFTs, on and on and on it goes. The problem is you have no idea what any of these mean or which one is right for you in your given investment needs. So, brought Stefan on to enlighten us on some of the various investment accounts that we can use and the different investments that we can put into these accounts. So, let's hop right into it.
Perfect. So thanks so much again for having me here.
Thanks
for all jumping online and just watching this podcast or listening to it. We're just going to go through a couple of these account types, how they're helpful. And then I thought it would be helpful also just on the tail end, since we got accounted here, that we can talk a little bit about the taxes on how the taxes can affect each of these accounts.
Sure.
So
let's do it.
Let's get it. Let's talk about the RRSP first of all.
Sure.
The RRSP is the Registered Retirement Savings Plan. And this is designed to defer taxes. You can contribute to it and then defer the taxes, and then ideally be drawing it out at a lower tax bracket. So what that kind of looks like is you reduce taxable income during your working years. Mm-hmm. It encourages disciplined retirement savings and can be used for a homebuyers plan or lifelong learning plan.
For sure.
Okay. The drawbacks. What's the drawbacks with an RRSP? Well, it is taxed as income. So any withdrawals are taxed as income.
Sure.
And then at age 71, it'll be converted to a RIF, which the government imposes that you need to withdraw a certain percentage, which increases every year after that. So let's say it's 5.5% at age 71. It's then going to continue to grow up to the intended goal of having all the money being taxed.
Right.
All right. So what's an example of that? Well, John, who lives in Alberta, earns $100,000 as an employee. He would pay taxes, leaving him with $73,550 after tax. But if he contributes to an RRSP, $20,000, his after tax is only $79,650. So the difference is just over $6,000. Mm-hmm. Ideally, what he'd want to do, and utilizing the RRSP account, is contribute that extra $6,100 plus, of course, the $20,000 that's in the RRSPs to his retirement savings, compound it, and then on a lower tax bracket, begin to withdraw that.
Right.
The interesting thing, I'd love to hear your thoughts on this, is the taxable nature on the RRSP. Now, upon his death, what happens to John?
Well, I guess it depends. If John has a spouse, then John can move his RRSP balance over to his spouse without any tax implications there. If John is a solo individual and he passes away with an RRSP balance there, unless there's some real extenuating circumstances in regards to a dependent that is, physically and financially dependent upon him, that RRSP balance is going to come into his income on his terminal tax return, and he is more than likely going to get hammered with tax in one way or the other. So my biggest thing with clients, and it is tricky because you're told, got to save all my life, got to plan for retirement. And while you need to do this, there is a point in time where you need to stop saving and start unwinding all of this, because if you leave a sizable balance in that RRSP or eventually that RIF account, you're looking at potentially up to 48% tax in Alberta, which I don't know about you, not a big fan of paying that much into the government.
Oh, you're not?
No,
Really?
I'm
Oh,
definitely
interesting.
not.
Okay,
No.
because I'm a big fan. So in other words, if you got $1 million, you're looking at $480,000 that you would be paying in tax. That's a huge impact to the beneficiaries that otherwise could have benefited from some good tax planning.
For sure.
So have a conversation with your advisor and just ask them, hey, maybe it's a better idea for us to start drawing down our RSPs a little sooner than waiting until later on.
100% agree. Yeah, if you got a bit of a window there between retirement and age 70, that's usually the sweet spot. You can defer CPP and OAS, open that up as wide as you can and try and withdraw some of those RRSP funds in that particular block of time. That I find to be the most helpful for most clients.
Yeah, and the benefit there by deferring the CPP and OAS is you do get an additional, if you go all the way from 65 to 70 on CPP, you'll get 42% increase on the amounts that you would be receiving at 65 and 36% on OAS. So it's kind of a double win
For sure.
on that side. TFSA, let's talk about that.
Let's do it.
TFSA is a tax-free savings account, and the government was generous enough to give us that account.
So nice of them.
Right? I think it's just over 100,000 that's of room.
Correct.
That you can contribute right now if you've never contributed. The benefit is it's just going to grow your invested money tax-free, and then you're going to be withdrawing that money tax-free. So that's a great win.
For sure.
The drawbacks, no tax deductions for contribution.
Correct.
Contribution room is limited, and the unused. So let's say, for instance, you withdraw $20,000 in that year. You can't recontribute that amount if you have no other room until the following year. So just keep that in mind. And there's a 1% fee that the government charges if you go over the room in the TFSA.
Right.
So just to have a conversation with your advisor on that. Here's an example. Sarah, who's 65, receiving CPP and OAS, had invested $100,000 into her TFSA during the past 15 years. And during that past 15 years, it doubled to $200,000.
Yeah, not bad.
Not bad. Good investor.
She was to talk to you, eh?
Must have had a conversation. She was going to withdraw $20,000 from her RRSPs for a vacation with the family.
Oh, nice.
Yeah, not bad.
But
good. There's a problem there.
Uh-oh.
Because it would affect her OAS. There could be a little clawback there. So we just want to be mindful of that. And so what she did was she had a conversation with her advisor, and he said, just take it from your TFSA. And she withdrew it from her TFSA, didn't affect her OAS, and she got it tax-free. So nice little thing. What happens on the estate for the TFSA? Let's have a conversation about that.
So basically the same fashion, it's non-taxable to the individual that's withdrawing it during their lifetime, similar to the estate. It's just going to flow through to whomever it's intended to go to. You can probably comment better. I believe it's called a successor annuit. Is that
Bingo.
correct?
Yeah.
So,
successor holder. I had to double check, but yeah.
Okay. So what that is, and correct me if I'm wrong, but I believe if you set that up, then you're able to move those funds into that particular individual's possession without impacting their TFSA limit. So if it was to go into the estate and then out to that person, then they would have to take the funds and put it into their own TFSA, whereby they would only have the availability of their maximum cap. Whereas if that individual was fully contributed and then they had these funds come across to them, they would still be allowed to put those into a TFSA under their name without any penalties. So setting up that transfer is a very important thing to take care of.
Yeah, that's excellent. So let's say, for instance, we had an individual who had $100,000. She was married or common law with John, and he had $100,000. Unfortunately, we have to kill John off. John dies.
Sorry, John.
But the benefit is, because of good planning, John had marked his wife, Mary, as the successor annuitant. And so that allowed that room of $100,000 to then also be owned by her and allowed for her to have her $100,000. So now she had $200,000, which she was the owner of, and tax-free. So nice benefit there.
For sure.
And thank you, government, for the TFSA. Everything else is taxed.
That's right.
Non-registered accounts. So what's a non-registered account? That can be held in a corporation or personally. And it really is, if you've run out of RRSP room or TFSA room,
Right.
well, this is going to be taxed as capital gains.
Sure.
So the benefit here, no restrictions on the contributions. So wealthier individuals are going to use that account.
Yep.
And the drawback is going to be no tax deferral. So there is some income on capital gains that are realized and then also deferred later on in life.
For sure.
So let's talk about those capital gains. So what does that look like? Well, if Tom invests $100,000 in a non-reg account, over 5 years, he earns $20,000, and he's going to have capital gains on that $20,000, which is 50%. So that's $10,000 is going to be taxable. The other $10,000 gets to enjoy no tax. That $10,000 is so 50%, or sorry, at $10,000. So that would be taxed on his marginal tax rate.
Correct. Yep.
So that $10,000, let's say he's at 30%. So 30% of the $10,000 is $3,000.
There you go.
So that would be how that account is taxed. Upon death, what happens to non-registered accounts upon death?
Similar speaking to that RRSP. So, if this individual had these accrued gains when they passed away, you would have what is called a deemed disposition for tax purposes. So on his terminal tax return, you have to take account of any accrued gains. You report them as if you had sold them on the last day that you were alive, and the estate would be responsible for paying that particular tax there. So again, you have to kind of watch if you've got some of these bigger RSP balances, bigger accrued gains in non-registered accounts. If you are getting close to your expiry date, you need to ensure you're doing a bit of planning there, because all this is just going to come into income at one point in time and translate into some tax. Now, you're probably a little bit better off with the non-registered, because some of that is probably just going to translate into that 50% inclusion, whereas the RSP, 100% income inclusion. But still important to be mindful of the whole picture to ensure you're winding these things down as best as possible before you hit life expectancy date.
Yeah,
so
very well said. So when we're talking about the non-registered, if you utilize segregated funds, you can earmark a beneficiary there, bypassing probate. But keep in mind, we want to have good planning in place. There is going to be a tax that is going to need to be paid by the estate. If not the estate, beneficiaries could be pursued, especially when it comes to the RSP taxes.
Yep.
So keep that in mind. We want to use these accounts as intended, but there's a lot more planning that you might want to involve, especially when we're thinking about next generation, estate harmony, and also taxes.
Agreed.
Okay. So
what's next?
RESPs. What is it? RESP is a tax advantage account that the government says, hey, listen, we're going to give you some extra money to help your kids in their post-secondary education.
Right.
So that's a great move on the government side. Thank you so much. So they'll give $500 a year, I think up to $7,500 if I remember correctly. Withdrawal for education in the child's hands. So that's the benefit there. It's not going to be taxed in the parents' hands.
Right.
It's going to be taxed in the child's hands. And typically that's going to be at a much lower, if no tax at all, since the child is going to school.
For sure.
That's pretty much all I want to say on that, unless you wanted to say anything else.
No, so the RESP, good for, again, planning for kids' post-secondary education. As far as I'm aware, the uses are quite varied nowadays. You can go into traditional post-secondary, trade schools, things of that nature. I think there's a fair amount of flexibility there. The amounts that you put into that are not tax deductible to you And like Stefan mentioned, it's going to sit there, accrue in value, and at some point in time, that will become income to the child. If you don't use it for whatever reason, the Canada bond aspect of it goes back to the government, but your principal and any accrued investment income, whatever it happens to be, that still is retained by you. But if you pull it out, then that translates into income to you. And I just remember, for whatever reason, I'll never forget this, when we went to set one up for my son when he was quite young, I just remember the investment advisor at that point in time saying, while this is a good step and it's helpful to get them, going in life once they get out of high school, don't put their education ahead of your retirement plan. Speaking from my own personal experience, my parents put away enough for me to do 2 years at college, and then I went and worked full time thereafter, and I had all of the rest of my degree, my designation, everything else paid for by my employer. So my parents didn't need to have the money there. And there's numerous ways for kids to do this, these days, whether you're working as an apprentice or whatever it is, you can earn income while you're working. It's better to have some sort of nest egg, I would think, for yourself, than to completely empty the bank account trying to get the kid through post-secondary to pick up a bachelor of whatever degree that doesn't translate into something that maybe
art absolutely does
generate some income after the fact. So yeah, good. Plan for your kids, but don't forget about your own retirement.
Well said. And I think in a previous episode, I commented on that, very similar to what you'd said. So
for sure,
I concur 100%. Yeah. With the RESP, use it as intended, and just realize that the other thing is if you are concerned about the RESP and the child not going to post-secondary education, the amounts that you deposited, the growth on that's going to move over into an RRSP. We could do that. The grants and the bonds, however, is going to go back to the government. The interest should go into your pocket, though.
Yep.
So
fair enough.
There you go. Okay, RDSP. Let's talk about that.
Sure.
RDSP, it's a registered disability savings plan. The government's quite generous on this side. They'll give up to $3,500 a year towards this.
Yeah.
That's very nice. The funds are going to grow tax-free and can be used for disability-related expenses. So the thing to note on this is they're a little bit finicky.
Okay.
Okay, so the temporary RDSPs, you're going to have to go talk with your doctor on every 3 to 5 years. You have to qualify for that.
Fun.
And just it's for the permanent ones every 5 to 10 years. You need to qualify by your doctor. He has to sign a form.
I'm aware of that.
He has to sign a form for that. So there's also a 10-year withholding phase that will take place. So just keep that in mind, which would mean that the grants and bonds that were contributed by the government would be withheld if you had taken out money within the first 10 years. That wasn't, or you didn't qualify for it.
Gotcha.
So RDSPs, have a conversation with your advisor and just keep that in mind. They are a little finicky, but set up for the right individual, it can really benefit them.
Makes sense.
Yeah, let's move on.
Sure.
FHSA, first-time homebuyer savings account. This one came out 2023, so a lot of people are quite excited about this.
Sure.
And you have a little technique that you'd recommend on this podcast for the first-time homebuyer savings account.
I think if you are in the market to be buying a house, this actually is a good account that is being put out by the government. It does give you some flexibility to plan ahead for that first home. What I've seen with some clients in kind of dealing with some of these is the most important thing is to get the account open. You don't necessarily need to contribute in that year, but you need to get the account open. And it doesn't work in a similar fashion as the tax-free savings account, whereby another year ticks by and you just get, some added room added to your TFSA balance. In regards to the FHSA, you need to open it in order to generate that contribution room. So, whether or not you've got the $8,000 annual amount that you can stick in or not, it doesn't matter. If you are younger and you eventually want to buy a house, go open one of these accounts with Stefan. When you get some money, you can stick it in there, and it'll keep bumping up that room as a result of it being open, not just based on the fact that you are a living, breathing human.
Yes.
So that's an important factor. It works in a similar way to an RSP. You put the money in, it comes off of your tax bill come, in the next filing season. When you want to go buy that house, it works in a similar fashion as that Homebuyers amount, but there's more flexibility in regards to how you apply it. You can move it into an RSP if for whatever reason you don't end up using it. And there's some different stipulations on the repayment terms, things of that nature. So it does provide you with some benefits there. And overall, if you're young, if you're in the market to buy a house, I'd probably suggest you go open one up.
Yeah, that's right. Just because you open up an account doesn't mean that you suddenly have to buy a house. Think of it like a combination of an RRSP and a TFSA. So you contribute to it for a first-time home buyer saving or for a first-time home. It grows tax-free. You have $8,000 of room that you can contribute once the account is opened annually, growing up to, I think it's
40,000.
40,000, that's right. 40,000. And the benefit is as you withdraw it, you can withdraw it tax-free for that person and for that home. And so that's a great benefit there. Plus, you can also combine the spouse if they open up an account.
Sure.
Now we have $80,000 going towards the deposit, which is tax-free, which is great.
For sure.
So keep that in mind there.
Excellent.
One last little note, it's finicky when you go to withdraw. So your timing, you have a 30-day, typically around a 30-day window. Just have a conversation with your advisor when you're going to buy that house.
Yeah, okay.
And make sure the paperwork is drawn up for that qualifying home. There's some parameters on the qualifying side, so before you open up an account, just keep that in mind.
Makes sense.
Investment types. So we're going to fly through this.
Let's do it.
Investment types. So stocks are equities. What are they? Stocks represent ownership in a company. When you buy stock, you own a portion of that company and benefit from its growth and profits, but also its decline and losses.
Sure.
So it's not a fund of companies.
Right.
It's a stock.
A specific. I.e. you go buy Apple, or you go buy Enron, or you go buy
Microsoft.
Yes.
Right? If you're a big Microsoft
For sure.
guy. High potential for long-term growth. Dividend-paying stocks provide regular income and great for building wealth over time. The drawback is it's volatile.
Yep.
So if you aren't into risk, don't buy individual stocks.
So if you're 80 years old and you have a couple $100,000 in a heavy laden oil stock portfolio, may or may not be a great idea at that particular point in time.
That's right. You have to be mindful of this. There's, if you, there was a recent story where someone owned a volatile company. They passed away and it was stuck in the estate because the wife wasn't named as a successor. And that lost hundreds of thousands of dollars.
Yeah, that's no good.
So just
talk to your advisor.
Talk to your advisor.
There you go.
Mutual funds. This might be a better option for someone who wants a little bit less risk. So a mutual fund, it's a mutual fund pool of money for many investors to buy diversified portfolios of stocks, bonds, or other assets. It's managed by a professional. It's nice and diversified. So you're not just buying one stock, you're buying many companies. And management fees can be a touch higher, but you're paying for diversification and you're paying for someone else to manage that money for you.
Gotcha.
So that is a nice benefit. And mutual funds can be held in non-registered accounts, RRSPs, TFSAs, you name it.
Sure.
ETFs. What are they? ETFs are similar to mutual funds, but are traded on the stock exchanges. They typically track the index. So if you've ever heard the S&P 500, NASDAQ, these are indexes. So it's very similar. And so these can be managed or they can be passive.
Gotcha.
Managed sometimes can just carry a little bit more of a fee.
Sure. Why not?
But passive is going to carry a little bit less of a fee. It's just not going to be managed. So it'll just ride the index.
Give and take.
Yeah.
Sure.
So
makes sense.
Talk to your advisor on your risk level and go for it.
All right.
Let's go to the next one. Anything on the tax side that you wanted to mention?
I think these are all fairly straightforward. I'll button it up at the
Okay,
end. How's that
perfect.
sound?
Bonds, what are they? Bonds are fixed income instruments. There's a loan by a corporation or government. You buy that loan, or
Right.
the portfolio manager buys that loan and is guaranteed. Typically, this is the amount, I shouldn't say guaranteed, the amount that they're expecting,
Right.
let's say 5% on a 5-year bond, they're going to get back. Most of the times, governments are going to honor that.
Sure.
Russia was paying their bonds even into the Ukrainian war. So
Pretty safe.
pretty safe.
Fair enough.
These, what are they? GICs are a low risk investment. Banks love selling these, and it's a good product if you need something guaranteed.
Right.
Lots of people buy these. You can buy 1 year, 3 year, 5 year, 10-year GICs.
Sure.
And you're guaranteed to get that money 3% or 4% or whatever their post rate is,
Right.
provided that you hold it out to maturity.
Fair enough.
And alternative assets, real estate, commodities, crypto, private equity, that's going to be, pretty much just like that. And real estate profits are taxed as capital gains when sold. Rental income is taxable annually, but includes deductible expenses, mortgage interest, property taxes. Cryptocurrencies are taxed as capital gains. To me about that.
I would probably say it depends.
If they get caught.
Well, not so much that. It kind of boils into the same thing as maybe if you're holding some of these stocks. So if you are in the nature of trade, i.e. you're getting up at 5 in the morning every day, you're researching, you're making a whole bunch of trades all the time, whether it's in a traditional stock or some type of crypto, you could potentially be called what is a day trader. So instead of having your profits from any of the sales of these particular items treated as a capital item, they're treated as a business item. So thereby 100% of the profits go into income. Any losses would obviously be treated as 100% loss as well. So you just have to determine what it is that you plan to do with it. Are you going to go and buy some Apple stock and hold it until the day you die? Chances are when you pass away, that should be treated as capital. But if you're on the daily exchanges making 50 trades a day and you pass away, you're probably going to have a bit of a different tax treatment on that. So it's all about the intent. That's how CRA would kind of look at those particular items.
I just want to say a mention on the real estate properties. If someone dares to depreciate their real estate property, talk to me about what kind of tax are they expected to pay, because essentially they've just brought down the ACB.
So what ends up happening if you depreciate a rental property as you're going along, you're going to see a tax benefit in those given years that you're claiming that depreciation. What ends up happening, whether you have a deemed disposition down the road when you pass, or you actually just sell it outright while you're still alive, you've brought down the tax pool balance on that. So if you sell for in excess of whatever's in that tax pool, you're going to see what is called recapture. So you've seen this tax benefit over the years, dropping your taxable income because of that depreciation. Now you're going to take all of that and bring it back into income in the particular year that you're reporting this disposal. So not only could you see a potential capital gain when you sell that rental property, but you might also see some recapture brought into income as well. Now, does it make sense to do that, or is it a bad idea? Again, it probably all depends. If you have the intent of buying one rental property, holding it for the next 40 years, and that's just going to be a little chunk of your retirement income, I would say don't bother depreciating it. Pay the tax on the rental income as you go. When you get done, hopefully you got it in joint title with your wife. You sell it off, you split the gain 50-50. The tax is probably not that big of a deal. If, however, you have some sort of intent to be the next real estate mogul and you want to still build this portfolio, you might look at using a non-cash item such as depreciation to lower your annual income, thereby freeing up cash flow to then keep buying properties. So it depends on what you want to do.
Talk to your accountant.
Fair enough.
Awesome. Best investment types for corporations, dividend-paying stocks.
I would agree.
Yep. Dividend-paying stocks. They're tax efficient due to the dividend gross up and credit system. They're good for generating income. I also like ETFs. Mm-hmm. They're going to be taxed at capital gains, so most effective within the corporate structure. Corporate bonds, GICs, you could do that. And then real estate, stable cash flow, and appreciation opportunities.
So just watch on the dividends. If they're coming into your corporation, those will attract what is called Part 4 tax. So it's a tax specifically on that dividend income. So you can have a loss in your operating company, but receive dividends, and you'll still have that Part 4 tax to pay. So keep that in mind. You can kind of whittle that down by paying dividends out to yourself. So again, if you've got some flexibility to kind of push some remuneration out to yourself via dividends, or if you just take dividends as a part of your overall strategy, you don't take wages, then it's not going to much matter. Just collect that dividend income. It'll flow right out to you, and you're no worse for the wear. But if you are in a active position and you're receiving some of this and you don't have the means to pay anything out to yourselves, you can put yourself in a bit of a cash crunch there, because that Part 4 tax doesn't disappear because you have a loss on the operating side. So something to watch there.
Yeah, and obviously all these comments are going to be relative to each individual need. So I hate saying it again, but it depends.
It depends.
It depends.
It depends.
Okay. So best investment type for personal use. Again, it just really depends on what you want to do, what you want to accomplish. Maybe RRSPs might not be the best thing at this moment for you, especially if you're below $50,000.
Right.
But I would also strongly suggest, if you are very conservative, or at least your risk assessment is conservative and you're 20, maybe have a conversation again with your advisor and say, hey, listen, let's take advantage. I have a long time horizon to recover any losses in the markets. Let's go maybe a 70-30 portfolio and get more equities in there than bonds. And let's not hold on to as many GICs, because you're actually losing the opportunity of compound nature.
For sure.
And that would be my comments.
Perfect. So one thing I did want to touch on there, we had mentioned the real estate real quick. So typically and traditionally, it is subject to capital gains. You hold that piece of property, you sell it for a capital gain. You need to watch. They put in some house flipping rules here over the past year. And in respect to that, if you hold a house and you sell it in less than 365 days, you'll be subject to these house flipping rules. So instead of seeing capital gains treatment, it's brought into income as business income, subject to tax at full rate plus CPP on any of that business income. So there are some very detailed exemptions, i.e., there's a spousal breakup, someone passes away, you need to move away for a job. Some of these more major life events, you can claim an exemption under that to kind of get out of this. But if the intent was to, hold it and sell it, you're going to be in rough shape if you aren't aware of these rules and you sell that property just short. Because, just seeing clients just in general, as the market kind of ticks up here lately, you can have something and see it tick up quite a few dollars in less than a year, and people get a little bit engaged and excited to be selling these properties as soon as these profits are upticking. But if you're not wanting to fall offside of these rules, just make sure you're holding it for that 365-day period before you offload that property.
So 101 days, you'll be okay.
101 days, you will not be okay.
Oh.
No. In excess of a year. 365 days.
Did I say 101?
101.
I meant 1 year and 1 day. That's what I meant.
Okay. Yes. Yeah. 101, you're in rough shape. 366, unless it's a leap year, you should be in okay. But yeah, again, that probably boils down to the intent of it too. So if you start buying houses and you start selling them on 366 day each year, presumably eventually CRA might say, you're in the business of buying and selling houses. Just because you are kicking this down the road by a day maybe the intent here isn't what you're actually transpiring on your tax return. So it all boils down to intent in my viewpoint. So making sure you have a plan in place as to what it is you're doing with these properties is probably going to save you some headache down the road.
Look at that, guys. We got real estate advice and we talked about account types.
There you go. Anything in closing?
I think this is perfect. I think at the end of the day, it depends on everyone's situation. There's a lot of accounts out there with a lot of acronyms.
For sure.
So to keep things simple, talk with your advisor and make sure that your advisor is giving you a plan all the way up to retirement, but not just growing your wealth, but also planning for what happens when it transitions. So we don't want to see lots of clients saddled with a large tax bill at the end. We'd rather see things move over to the next generations, if that's the wishes of the client,
For sure.
In a very harmonious way. So
Agreed. Perfect. So in closing, what do we suggest that you do to ensure you permanently resolve any of these concerns that you had related to today's podcast episode? So number one, whether you're on YouTube, Spotify, whatever the case might be, please subscribe. Throw some comments down there. We'll be happy to get back to you and reply to some of those concerns that have cropped up. And feel free to check out our website, legacyllp.ca, for more information. And feel free to touch base with Stefan. What is the easiest way for the viewers to get a hold of you, Stefan?
yeah, just shoot me an email, svanzanten@bridgelinewealth.ca. Again, that's svanzanten@bridgelinewealth.ca. And I'd be happy to respond to any of your comments or questions.
Excellent. Well, thank you again for taking some time to record this podcast with me. I know it will be very helpful for everyone out there to provide some guidance and just some general ideas onto all of these acronymed accounts and how to proceed onwards. So for the Tax Talk podcast, I'm Jared Plon. Thanks again for watching. Take care, and we will see you on the next episode.